Now with regard to the session timings, this is the timing followed by that of the players. So we are in the US session, 13:30 GMT, the European session has started, US session has started. Now we are on around 14:15 GMT in the early European session. Still, Euro has not come above that of the initial low, 1.4140, and GBP also has not come above that of 1.6135. So they are going to make the slide during that of the US session. And gap times indicate also the false moves, and you would have noticed that during that of the gap time between 13 and 13:30 GMT, before the start of the US session, they made a firming up move quickly after making a drop for 13 GMT, closing of the European session, and that particular gain indicated that they wanted to drop at least for 30 minutes during the start of the session. During such firming up move, if you take a sell within 30 minutes of your US session, you will be able to book a nominal swing trade profit. That is referred as a gap time trade. Okay, so then let me explain the trading system. We track the market using the GMT time so that we'll be able to understand that throughout the day how exactly they are making the moves rather than referring to our local time. Then also give importance to that of the gap time, session start time, late session, and also the mid session. Mid session they handle the crosses, and the early and the late sessions they handle the majors. So this is the link I use for tracking the live market quote page, and also I have given the link in the hotcom window. Then always refer the market whenever you just refer to it, to that of the high and the low set for the day or for that particular session, and also observe the next change. For example, the high in the case of Euro is not being breached, high in the case of GBP is not being breached, market is trading below that of the initial low in the case of Euro and GBP, and also Australian dollar. So we know that when they hold the market throughout the day like that, there will be more selling pressure, because yesterday they have been holding high and they have been rising Euro GBP in order to give that impression that it could go further up. But actually they just gained the levels and build a sell position. Now they are holding it for any trigger to come, and the stress test could be used as a trigger, and they could make the drop irrespective of the outcome, so that those who are holding the long positions will come for the long liquidations. So normally what they do is they gain the levels and induce the traders to do the short covering when they are all selling with a bearish feel, and change the mindset of the traders to become bullish and turn long, and giving that impression that it could go up further, but without gaining much, they hold at a higher level and start making the drop. The initial drop, traders tend to do the averaging for the buy position. Later on they become bearish and just cut the positions. This is how you find invariably that traders lose money in the market. So don't be along with that of the herd of the traders, and try to see that the players are also traders, and they gain the levels quickly and book profit and drop the market, buy back. So when they gain the levels quickly and book profit, that means they are sellers at the higher level and they are buyers at the lower level. Whereas we try to do it opposite with a bullish and a bearish feel. So try to avoid it, then you will be able to really handle the market very well. Then mid sessions they handle the crosses, so during that time try to avoid taking positions in the majors. During the start of the session, end of the session you can take positions, but mid session they will be handling crosses. At that time, if you try to take the position in the majors, you might be holding it for a longer time. So then with regard to the entry decision, when the market is closer to that of the high, you can take a sell position. When the market is near the low, you can take a buy position. In case they are not breached the low or the high in the first 30 minutes of your observation. Now you find that they are holding below that of the initial low, but at the same time they are not breached the low. So if they come closer to low, we can take a buy in order to book profit. During a small firming up move, they could make by 16 GMT during the stress test announcement, result announcement. So normally they make a false move before that of the data release time. If they drop before that of the data, that means they wanted to rise after the data release, irrespective of the nature of the data. And similarly, they gain the levels very quickly before the data. Understand they are most likely to drop after the data. There might be a volatile move here and there in order to confuse traders, but you have to read their intentions and then you will find it very easy to trade. And once you have taken a buy position near the low, your first exit target should be near the high. And if you've taken a sell position, your first exit target should be near that of the low. That is how you have to mentally prepare yourself. And when the level comes, you can review it using a trailing stop in a profit-making position. Once the position makes about 20-25 pips profit, keep stop at entry so that you are eliminating the risk. Because trading is always combined with that of the risk. That is why in every trading platform they ask you to sign a risk disclosure stating that you understand the risk. So be serious with regard to the risk, understanding the element of risk, because that can really shake you up. So to avoid it, once the position makes profit, immediately keep stop at entry. Even if they hit it, no problem. You don't lose any money. And similarly, if they make profit, then trail the stop, maintaining 15 pips from that of the market, and keep the limit. If they hit your stop, fine, you get the minimal profit. If they hit your limit, you get the maximum profit. And you can move the limit away from that of the market in order to maximize that if the trailing stop is not filled. But don't move that trailing stop away from that of the market. That may lead to that of incurring loss. Then, so the exit you may estimate statistically, or you know that statistically you may estimate the market may not respect those levels. So try to keep at least 5-10 pips above or below on that of the estimated, because whatever we theoretically estimated, there is no guarantee that the market need to respect it. And also many of the people statistically estimate the support and the resistance and try to keep above that or below that the stops. And invariably you find the stops are being filled. And the main reason is the players also use such similar statistical methods and find where the cluster of stops will be. Besides statistically confirm it, they also visibly get it from other sources and try to hit the stops. So you have to understand that in amidst the cunning people, we have to earn money. That's what I can tell you. Then avoid impulsive decisions. So when the market is rising, don't jump into it thinking that it will rise indefinitely, or when the market is dropping, don't jump into it. And that may lead to a distressed trade. And unless and otherwise you do quickly the risk aversion or the risk limiting factors like keeping stop at entry and try to watch the market and grab the profit. If you don't have that quick-wittedness, then it will be extremely difficult for you to exit out of such trades. So as small trader, don't expose your equity to a great level and try to take very limited position and try to see that you grab the profit. My best suggestion will be, just in case we have got a sell or a buy position, keep a limit and don't add any more positions and simply wait for the market to fill the limit. Probably it may take 1 day or 2 days, doesn't matter. Then the next day if you try to do it, another trade, and that will be able to give you consistent profit. And you know market main swings. So always keep in mind your entry will be above that, near that of the high, a sell entry, or near that of the low, a buy entry. Then the element of you being stopped out will be very, very less. So in case if they breach the high or the low, then it could be due to that of the extended move or the intentional move or extended stop end. So if it is an extended move, in case they breach the high and stay above there for more than 30 minutes and rise, then they can rise for 2 hours. So don't immediately jump into the market and take sell position. Wait for the market to cool down, wait for 2 hours, then afterwards you can take a sell position, and after the extended move, they may not do the intentional move on the same day. They may most likely do the intentional move the very next day or then the very next week. In such a situation, you can only take a sell position and wait for the next day. During that intentional move of drop, you can book profit. Otherwise, if you do not want to enter at that time, then next day they will make an upward stop and before making a drop to hit all the stops of the short sellers who are taken at the highest level. At that time, if you try to take a sell position for the week beginning, then you will be able to really maximize the profit. So understand what are their weaknesses and try to exploit it rather than trying to hit the players on their strength. That's what my humble suggestion could be, because we cannot trade against them. Then if the market cuts the high or the low, and if it stayed below that of the low, now in the case of euro, they are staying below that of the low, euro and they are slowly dipping it, and they are trying to build sell positions here. It might be, you might be wondering, they are keeping it at a lower level, but when they keep below that of the initial low, and during that of the late European session and that of the US session, they are building sell positions here, and people might think that those who are holding the higher level long position, they might liquidate, and some people might think that okay, the low has not been breached, so it's a strong support is seen around 4100, so why not we take a sell buy position. That is how the analysis might be, but later on see how the intentional move comes into that of the market, because the players are here not to rise or drop euro. That is not their objective at all. They wanted to bring in volatility, create uncertainty, and make the traders to become distressed traders, and they induce them to buy it at the higher level, sell it at the lower level, and that is what day in and day out they do it and successfully earn money.